Good morning, everybody. Thank you so much for coming. It was a pretty wild, crazy cocktail hour last night. We're going to be joined on stage today by my colleague and friend over here, Nova Lorraine, award-winning fashion designer, futurist, and founder of the House of Lorraine. Thank you so much for joining us today. We've got another amazing day of content ahead for us. Yesterday we had Newsbreak on stage. Barry Silbert launched a digital asset management company for institutional investors that wanted to get involved with the alpha token on Bitensor. Nova, tell us a little bit about what you did yesterday and what we have in store today.
Yeah, happy to. And good morning, everyone. Good morning.
Morning.
Good morning. I'm going to help you wake up this morning. Welcome to day 2 of the Proof of Talk. I'm Nova Lorraine. As my lovely colleague here, Michael, mentioned, I am the founder of the House of Nova. And I was really excited yesterday because we not only talked about the momentum in the space, but we touched on real use cases. And I think we're all ready for that, right? And we went beyond the surface, as we usually do here at the Proof of Talk, and we looked at what projects are actually making impact. And so some of the conversations we had were from Bitcoin layer 2s to decentralized science, super excited about that, to emerging markets. I'm from Jamaica, so I was really interested in hearing what they were doing in the emerging market space, as well as aligning sustainability with compute. How do we do this in this new era where energy is such a big topic and interest, especially around blockchain and AI? And then, of course, today, we're going to be covering everything from subnets to stable coins. We'll be hearing from global leaders and regulators, DeFis, and crypto natives. So we have a full schedule today as well.
It's going to be a wild, crazy one. Great line of content here. We're going to get things started off right now. We've got an amazing panel coming up. Why don't we welcome to the stage right now?
All right. You guys ready for your set of speakers? Yes, yes, yes. OK, we're going to play a game. If you ever come to my stage in there, you know I like playing games. So for each speaker, we're just announcing their first name per their request. But I want you to give each of them a really warm welcome as they come onto the stage. They came from far and wide, and we want them to know that we're here to listen, and we're really happy that they're here. OK? We're good? We're good with that?
Let's do it.
All right, amazing. All right, without further ado, let's get this party started. This panel is going to be Roadmap for the Tokenization of Financial Assets. And I would like to first welcome to the stage Dotun, please come to the stage. Woo woo!
Dotun!
Dotun is a director of emerging technology for LSEG. We have Elliot following close behind.
Elliot!
He's the head of macro policy research at State Street. Welcome, Elliot. Raj B is up next. Let's go, Raj. He's the co-founder and CEO of Blockridge. And Lloyd W., you're up next.
Lloyd!
Founder and CEO of MembersCap and Mana Group. And last but certainly not least, we have our moderator, Youngsun. Come on stage. He's the head of product at
Thank
Flipster.
you all. Have a great day.
Enjoy, everyone.
Bonjour, Paris. Good morning, Paris. How are you guys? For today, we have a wonderful lineup of panels coming from various industries, representing each sides of financial market to talk about the roadmap for the tokenization of financial assets. We're going to go through an introduction of our wonderful speakers first, and then head on to our topic first. But I do want to give one starting question to the audience, just for the speakers to have a better understanding of where we lie. Who here is familiar and you think you know the concept of tokenization of financial assets? Just honestly speaking. We have half. So we have half of people who are more aware. I guess we have half people. We want to educate and have a better sense of it after the session. So now with that said, we'd like to start with Lloyd. Just a quick, brief intro about yourself and what you do. and then we can go to our topics straight on.
Thank you. Lloyd Warhead, CEO, founder of the Mana Group. We're an investment platform in financial technology. From that business, you might know Searching for Mana. It's a podcast I host where we've had Kathy Wood, Jeremy Allaire, Anatoly, and we're really trying to put a spotlight on the leaders in innovation in the digital asset space. And then a few years ago, I founded MembersCap, and we are tokenizing an asset manager, and particularly the asset class is reinsurance. And we're doing that because we believe that the space needs a safe haven, less volatile, risk remote way to manage their capital.
Raj?
Hey, my name is Raj Brahmbhatt. I'm the co-founder and CEO of Blockridge. Our main mission is to make privately held assets programmable. The purpose behind doing so is to, number one, automate compliance processes. Number two, enable wider distribution. And number three, most importantly, increase the amount of things you can do with your assets within the existing financial markets.
Elliot, Hentov. I run macro policy research for a large asset manager, State Street. The reason I'm here, because it's very much a TradFi role, is that a few years ago we developed a new research stream called Macro Digital Research, where we think about how is blockchain finance and innovation actually changing the financial architecture? How does it change capital markets overall? Does it change how global allocators put their money? Where does capital flow? And trying to think through these issues. And most recently, we really spent time thinking about mapping out asset tokenization across all asset classes in capital markets, the timing, the impact, and some of that is what I'm hoping to share today.
Brilliant. Great to meet you all. So I'm Dotun Rominiyi. I'm the Director of Emerging Technology at the London Stock Exchange Group. My focus has been, at least over the last sort of 6 years, leading digital assets technology strategy at the group. We have built, over the last 3 years, a new digital assets business that we call DMI, Digital Market Infrastructure. So we're sort of a 100-person organization, largely focused on tokenization of existing financial instruments, where we provide services front to back around lifecycle management of those assets on a multi-asset class basis and on a multi-chain basis too. Great to meet you all.
All right. Now, that said, I do want to start off with asking a simple and easy question. Maybe I can start with Elliot on, where do we think the current tokenization of financial assets lie? As in, we have some progress. Some of the stablecoin sectors or some other sectors are showing progress of tokenizing financial assets. We have some challenges. So where do you think we are at, if you have to choose from like 1 to 10 as a stage of progression? And what do you think lies ahead, just as a starter?
I know it's early morning, and I promise I'll keep it to a minute, but a tiny bit of theory here. When you have, typically technologies are agnostic. They just make whatever you're doing better and more efficient. Tokenization is slightly different because it requires the whole network to change. The big change here is it's about the supply side, meaning it helps the issuers more than anything else deliver their products, their funds, their instruments more easily to the market. So it expands supply. It makes it cheaper. Raj will talk a lot about that. That's the innovation for financial assets above all. And there's a little bit of a demand function for those parts that you get tokenized that you couldn't have access before, but now because they're tokenized, it's getting easier. The ticket size gets smaller, or the barriers to entry are easier. And so that's really how you have to think about it. And so when you think about capital markets broadly, which part of the market's not working well, that's where you're going to have the biggest impact. So the parts that are hard to get to, the ones that are expensive to run, that's where tokenization is going to have the biggest impact. And obviously, Raj, I think, will talk a lot about that in the private space.
Yeah, absolutely. I mean, look, firstly, I believe tokenization is truly a blue ocean opportunity. I foresee a future where the entire capital markets will transition to blockchain technology in one way, shape, or form. In the short term, where I see a lot of utility being derived is within DeFi. And speaking of DeFi, what has worked really well till date, it's lending borrowing, right? You look at Aave, Compound, Curve, Finance, etc. So today you can see looping strategies already active with Apollo and Securitize, right? You can take really safe TradFi assets and augment the yields all the way from 8% to 13%. So I see in the short term that being a very useful way to optimize tokenization and its utilization. And additionally, real-world assets are better collateral than most things because they have inherent value. So over time, I foresee people keeping more and more of their idle capital within tokenized private equity and private credit because they'll have hyper availability to be able to borrow capital against it whenever needed. So that's kind of the short-term targets.
Dotun, I do want to ask from a service provider perspective, like what are some opportunities does the tokenization provide within this environment?
Yeah, it's a great question. So we would sort of bucket up the value proposition of tokenization into three sort of core areas, and many have sort of been touched on already in the panel. So certainly accessibility of financial instruments is a big one. I mean, we look at some of the use cases in and around, for example, take real estate funds, which have fairly high value assets, very, very large ticket sizes, typically require very specialized investors who have the competence to do the relevant due diligence to make these investments. Now, with this technology, you could take some of these investments, look at fractionalizing, some of those holdings, and then redistributing to provide access for smaller investors. And so that's sort of an interesting opportunity. Equally, on the other side, we see there's a lot of value in scaling efficiency. So it has already been mentioned around, how do we do things faster? Can we take settlement times for private and illiquid funds down from 45 days or 30 days to a couple of minutes? And in doing so, suddenly this asset class is more interesting to investors that today need to manage and hedge their risk on an intraday basis and therefore couldn't accept a fund that it would take 30 days to offload from their portfolio, whereas now this is a much more interesting asset class. And then on the final piece, it's sort of going into how do we think about market structure as it exists today, the types of activities that are conducted in and around some of these assets, and how that could evolve. So thinking about business model evolution and innovation. And certainly, some of the comments mentioned by Raj around, can we bring some of the benefits of pledging and collateralization and collateral financing to the private assets world, leveraging these technologies to unlock the accessibility of the assets, provide better mobility of the instruments, and therefore make them accessible to some of these liquidity pools for financing.
Yeah, I mean, I think we can imagine basically people having access to stable coins has really increased accessibility for people to have an opportunity to trade your currency to a dollar pegged, whatever financial asset it is. And those platforms that are serving that trading pair probably earn a lot of money off from it, right? So now that said, I think moving straight on to some of the drivers that are driving this interest, right? I want to put it to you, Lloyd. What do you think are some of the institutional drivers that are actually pushing this interest forward? And after that, I want to get straight to if there's interest, why do you think there's an interest, and why does tokenization matter?
Yeah, so we think there's 3 phases on the roadmap to 11 out of 10. And today is, quite frankly, remarkable, the engagement from institutions in tokenizing assets. So I mean, it's still a good 8 or 9 for me. But there's obviously a lot to do. But yeah, the question why, perhaps MembersCap is a good example of, hopefully. So if you think of reinsurance, maybe you'd be familiar with a Berkshire Hathaway or a pension or endowment fund investing into this for a very risk-remote, uncorrelated return. These environments are marvelously walled gardens that exist in Lloyd's of London or Bermuda, where you have a lot of intermediaries, brokers, administrators. So I think the natural thing that the space has done, builders, developers, programmers, has come after trying to disintermediate. It's a generically good narrative. However, to answer your question, if you go to any trading partner, it's not enough to make progress. Those downstream efficiencies are awesome, but to get there, what you need to do is come with risk capital. So we found that out the hard way, and it sounds so obvious now. But if you go to the reinsurance world, if you have a professionally managed investment office, and if you take new risk capital, then you can trade with them. And so this is the approach that we've taken. And so why tokenization is so that then we can take what would normally be a 100 million plus ticket to come into our portfolio all the way down to $50. So we are looking at the distribution side, smart contracts, an exchange of equity, and being able to bring in, to start with, high net worth individuals, family offices and so forth, who just haven't had access to this awesome asset class. And by doing that, the engagement is extreme, back to the point. So for us, really, it was to start with accessibility, and then our roadmap in phase 2 becomes about frequency of liquidity, and then in phase 3, it becomes about all the amazing network effects when you have a platform. And if you think of even the insurance policies, they're on chain as well, better provenance, a lot more programmability, and all the network effects of that.
Yeah, I mean, I was going to just move on to Raj because you did mention about, before our discussion, you did mention that you were focusing specifically on private side of the things. And I think that puts you on the spot to discuss why. Why are you focusing on that specific area from Blockridge?
Well, the core thesis is that on-chain capital markets infrastructure can significantly reduce cost of settlement and time to settlement. And the parallel side effect becomes that liquidity and accessibility to securities and assets goes up significantly for the end retail investor, and hence more liquidity can be influxed within the private markets. And I believe this is the primary driver for institutions today, such as asset managers, to categorically go out of their way to tokenize their existing funds, simply to be able to acquire more and more liquidity into those funds and assets in the short term. Now, over time, the primary driver will actually become global distribution and almost a democracy in capital markets, wherein people that have either high amounts of retained earnings by proportion in their checking and savings accounts, simply because they do not want correlated returns, will now have access to uncorrelated assets, and hence be able to build portfolios that are hedged against the current public markets.
So it seems like there's more efficiency building up, better distribution, better accessibility. It seems like a dream come true. I don't want to get to Elliot. You're touching upon some policy aspect of it. What are some of the risks, or what are some of the concerns in this space with regards to current progression?
Yeah, just to recap, if you think about, Raj is in the space where it's probably most exciting. It's private credit, private equity, real estate funds. Dotun mentioned it as well. That's where we have these inefficiencies today, so the problem solving is greatest. But there's one or two other parts of the market too. A market that we use, that we all rely on every day, that's still relatively inefficient, is the bond market. And it's less sexy, but in many ways that's where we're seeing the biggest revolutions happening today, and particularly around very technical features around collateralization options and so forth. That is obviously going to spread. The problem we've had, and I say that as one that, member of an organization that's a global systemic institution, it's been very hard to get policymakers and regulators to come along for this. So even Raj's example of wow, hey, the technology, we've made it easier. It's accessible. The costs are down. Now we can do low ticket sizes. Yeah, but you still cannot sell it to average retail investors. You're still not allowed to distribute it in conventional channels. You're still restricted on the old rails. And the problem really is to get policymakers on board, even those who embrace it. There's so much that needs to happen because every node in the system has to be re-regulated and reset. And so the technology is moving, like always, well ahead of where policy is.
I mean, in that regards, I think usually if we see the history of technological revolution paired with policy changes, I think it's usually the service providers or the platforms that have really driven the boundaries, right? Dotun, I do want to ask you, what are some of the challenges you're facing while building this? And what do you think is kind of like the pathway forward to get those policymakers at least to like listen or get on board?
Yeah, no, I would certainly echo some of Elliot's concerns around just the pace of evolution of sort of policy change. I mean, I will say we have seen some big strides in certain regions, both in the UK with the sort of DSS and some of the regulatory sandboxes, in Europe as well with the sort of the pilot regime. Obviously, Abu Dhabi, the UAE, they've been focused on building specific and established frameworks to support this type of innovation. The Monetary Authority of Singapore has been very amenable to a fairly dynamic approach to supporting innovation in this space. But ultimately, change is hard. I mean, we run similar to State Street. We're in the institutional space. We're a 300-plus-year-old organization that provides systemically important market infrastructure. We're probably some of the most risk-averse organizations in the world. And that's not just sort of market risks. We're looking at operational risks. And so there are lots of considerations here around how do we bring this technology to bear, how do we define the right risk control frameworks around these assets to protect our investment community, where if someone is making an investment in a $1 billion bond or $1 billion money market fund, they don't have to be concerned around a third-party wallet hack undermining that investment or potentially sending a transfer to a zero address. So it's these types of concerns that we want to bring together. They're not bearer instruments. Financial instruments today are largely non-bearer in nature, and therefore we want to sort of respect that through the right risk control frameworks and models for defining the assets. And I think the other consideration, and probably more of a structural one when we think about go-to-market, as this space is evolving, as many institutions like us and some of our largest clients today have been making significant investments in scaling our products and services, it's really, how do we think about interoperability? We're not all building on the same rails right now. So how do we get assets mobilized and sort of moving seamlessly and fluidly across different ledgers and different infrastructures? That's a hard problem. We today are thinking about private networks. Tomorrow we want to get to public networks. Obviously that's a journey, and how do we sort of bring that together? I like to use the sort of contrast with investment today in private assets is largely a conversation and some paper-based administration. You don't have a technology or infrastructure barrier to making an investment. Whereas when assets are digitized, suddenly that's created. So we need to sort of solve that emergent problem before we get going. Otherwise, we risk eroding a lot of the value that I think this technology brings into the space.
Yeah, I mean, I think it's a great point in addressing, the issuer side of things as well, like private versus public, even on chain, but also from a financial perspective. So I want to ask you, Lloyd, there are definitely cases where a tokenization kind of brings more accessibility, but also kind of puts people a little bit away from the central product. I'll give an example of this. Basically, if you buy an NFT, the initial purchaser would probably know the art's concept more because they were kind of closer. But as it goes to the market and gets, let's say, fragmented, people might not have the same understanding. Because you mentioned about like reinsurance products or insurance products getting more like tokenized, when you're thinking of like creating like these type of financial assets to tokenize, what are some of the things that you consider with that in mind?
Yeah, and I think it probably answers how we look at the cadence of policy here too. I think you have DeFi, which you can almost think of it operating in its own sandbox. Mm-hmm. And so I think it's about the education of risk that people are taking. And so our approach, because we're facing the reinsurance world and the credit rating agencies and the regulators have the highest bar as they should, we have to take a very cautious approach. So if we look at stable coins, we would take USDC, and at the moment we wouldn't take other stable coins, just because having conversations with the regulator, they like the way that Circle has behaved. They're looking at others over time. And so, really our responsibility is making sure that people are aware that this is something that fits into their portfolio, making them more aware of the risks. We've taken a very risk-remote approach because we think that's how reinsurance should sit in a portfolio. But if I look more broadly across the space to answer the overall question, I think overall the industry will innovate. So are there threats, are bad things happening right now? Yes. When technology comes into any market, you typically get, nefarious uses of it. We've seen a lot of that. We'll carry on seeing a lot of that. Overall, assets being tokenized, to Raj's point, I think is a wonderful thing for global distribution, for access, for many other reasons. So I think it's about, the good side of the space, educating, being very respectful of when they go to retail, not having bad blow-ups like we've had previously. And of course, the policy plays a pivotal role there. And I'm based in the UK, and I think they're taking a healthy approach. We work with, the key people there. And I don't know if it needs to move much quicker. I think currently right now, like I said, 8 or 9 out of 10, the way this space is getting looked at. But yeah, of course, there's still massive risks for people.
So the reason I asked was because of the fact that I wanted to ask a follow-up question to you and move on, was do you think that having a restriction or a regulation around issuer is necessary in this space? Or do you think that you should allow everyone to potentially just tokenize on top of a collateral asset? What's your view? Like, do you think everyone should be able to do it?
My personal view is no.
Okay. Would you agree, Elliot or Raj?
Yeah, for the most part, I do agree. Now, one thing to note is that what we have seen within the financial markets over time is dematerialization in one way, shape, or form, which is what happened back in the 80s when the stock market got digitized and paper stock wasn't necessarily being traded at the same scale anymore. And that is effectively the same trajectory we're heading into right now. And I believe that will continue to be the primary use case of tokenization, which is effectively how the assets are traded, how they're structured, and how they're distributed. Issuers, for the foreseeable future, will need to be within the existing regulatory framework. But to your point, that could change, right?
Look, regulation has a point. We've smoothened out big boom and bust cycles, and the problem is if you do just open the gates, you'll get another boom and bust cycle that can be very systemically risky. So the guardrails have to be in place. They just need to be modernized. The problem is that the modernization in this case is not just, hey, we're doing equities differently. No, this is about everything. This is about the custody, the collateralization, the whole distribution. Everything is changing. It's a network shift, and that requires I don't envy the policymakers.
Yeah, no. When I think about sort of policy generally, I sort of look to the stereotypical sort of jurisprudence of sort of financial markets regulation. Typically regulators have a few core mandates, and it's all about solving for investor protection, market stability, and then sort of increasing and sort of cultivating competition in the space to sort of like mitigate monopoly risk. And they do that through a number of different ways, but largely, the lens by which they think about the evolution of policy is this lens of, if it's the same activity, it carries the same risk, we should apply the same rules. And certainly as you've seen sort of the evolution of regulation with respect to digital assets and sort of, Web3, crypto assets, et cetera, they've tried to steer through that lens. I think where we've seen the most challenges, specifically on the tokenization side, it's not that the rules that we have aren't adequate in some cases, it's that there are existing rules that are predicated on certain assumptions that you need intermediaries to solve for managing risk and specifically market and systemic risk in certain contexts. And so these assumptions layer in the expectation that intermediaries will carry the function of being responsible for certain activities. And now we know through the digitization lens that through blockchain technology, we can actually disintermediate some of these activities through automation and mitigate the risks associated with the lack of trust. And so I think the consideration there is, and I think where we're seeing the big push with working closely with regulators is around how do we evolve some of these aspects of the rules to ensure that we can smooth those out, streamline, and provide bifurcation of the policy expectations to allow for the emergence and the innovation of these technologies to really bring that value.
Yeah. So it seems like the consensus is like we do need some level of guardrails within the panel. I want to move on to probably one of our interesting topics. Tokenization also comes with some centralization aspect to it because it allows liquidity to flow into certain directions. For example, like a USDT sucks up liquidity from other types of currency markets, potentially, especially in the crypto space. A lot of pairs are all USDT. With that said, what I want to hear from all the panels what the takes are in terms of that liquidity issue for the tokenization of specific underlying assets that you guys are dealing with. Maybe starting from Lloyd?
Yeah, so I think at the moment, distribution basically doesn't exist. It's been our experience of the platforms. However, it needs to start somewhere. So you've put think of it as rails down. And then if I look at our or other funds, we're capital market raising in a traditional way. We're having to get tickets over the line, and then we're introducing them to our partners, and there's many, as mentioned, kind of disintermediation isn't going to happen for a long time, which I think's good for now. And so, the holy grail is true liquid secondaries, which in different asset classes today is incredibly exciting. But if you start looking at others, it's 10 years down the path. So the question we're asking ourselves is, if we think of our customer, should we really provide high-frequency liquidity? Is that the best thing? And really the answer would be no overall, because the compound interest of staying in an asset class like this over time. So that's why we have somebody who firstly looks at it from a wealth management perspective, looks at the portfolio, and then for this slice that they're putting into their portfolio, takes a view on that. So phase one for us, again, in our 3 phases, is the access coming down and taking what is normally, if you think of, say, PE, a 10-year lockup, all the way down to 3 months, which has not happened in the space apart from when cat bonds came in. So we're happy with that. Do we think people should be trading on an hourly basis? In our instance, no, unless we built out further assets. And really for us, the big unlock here is if we can start getting to use the collateral that are tokens to generate the yield. So you see a lot of stablecoin plays here where they're providing a portfolio approach with that. So if you think of one of our customers who might be the treasury of a foundation of a protocol, they have a massive issue with over-concentration of their token, and quite frankly, very little else. Let's say some Bitcoin. And then whatever keeps the lights on from an OPEX perspective, and these foundations might have very large market caps, but more often than not much liquidity. And so the massive unlock here is if we can start moving over to that high concentration of token, and if we can start generating yield here for the OPEX, and then the innovation happens. So it's something we're working on with a bunch of partners. So we're more thinking, like I said, from a risk capital to us, unlock some of the treasury's assets, and then downstream to the customer over 3 phases, providing more liquidity, but not all at once, and I'm still not convinced that we should.
Yeah, I think it's a great point because a lot of people are fatigued when you get exposed 24/7 and high frequency at just one shot. So I think there's a great point in having that phases and trying to find the sweet balance to it. Raj?
You actually bring up a couple of good points, especially in regards to distribution and whether or not markets should transition towards high-frequency trading for traditionally illiquid assets. The primary problem that I foresee with doing the latter is that there's a lot of downsides to existing, black box, T+2 trade settlement infrastructure. But the one thing that really, really works is netting. Right? 98% of public market trades are netted off, and hence infrastructure is actually able to enable markets in a fluid manner. Blockchain technology and on-chain capital markets products are not necessarily built to do that today. So an emerging technology could be something like an accounting chain that actually does reconciliation throughout the day, and accordingly nets off trades on-chain. Maybe when that's possible, at least at the infrastructure level, high-frequency trading is a viable option. The financial repercussions of that are, effectively a different topic. We could go on and on about that. But as far as distribution goes, in the first phase, I really see that happening through existing distribution channels. So wealth managers, advisors, registered investment advisors, all of these entities, bodies, and individuals are effectively the filtering mechanism for the investor out there that doesn't necessarily know where to allocate. Now, through tokenization, what you can truly do for all of these distributors is lower investment minimums, because each and every asset can have wider distribution.
Yeah. It seems like there are some aspects of like centralization, distribution, all kind of mixed together. Elliot, we were talking before the session around like the future outlooks or the roadmap that we have to kind of head towards. Could you kind of give the audience a little bit of like a, enlightenment along like where the tokenization is kind of like going and should be going?
Well, just to recap, it's happening today in bonds, starting with money market funds, bond funds, and then regular bond trading, because that's still a market that's being disrupted. The up and coming one is, of course, the private fund industry. And your question with liquidity is, eventually, there's demand for private assets that's not met today. I mean, actually, I guess that makes two of you who are catering to that marketplace. But that money means you're going to reallocate out of other asset classes. So there is disruption and instability that comes. So you may think, oh, it's all great, there's just more liquidity over here. Yes, that's true, but that means also other markets or other institutions, particularly banks and insurance and other asset companies, may actually struggle with keeping and holding on to those assets.
Yeah, I just want to touch on the sort of liquidity points in addition. So, I mean, I think about liquidity in a couple of ways. Sometimes I think we run the risk in the sort of digital asset space, and largely given what we see around Web3 and crypto assets, we sort of run this assumption that when you digitize something, it automatically creates or provisions the means by which liquidity can then emerge. And I think it is a bit of a fallacy. I mean, ultimately, liquidity is a function of economic supply and demand. Demand for a lot of existing assets is fairly well served. I mean, public markets, if you want to invest and trade equities, they're probably one of the most liquid asset classes next to FX in the world. You can get access to these things. So, but there are private assets on the other side, some of which are relatively well served and others less so. And so really, I think the question is, where is there latent demand? Whether that be in getting access to investing and holding these instruments. Why do they want to hold those instruments? Do they want to treasury them, to gain access to the returns? If so, is secondary liquidity really a value proposition? If they want to incorporate them into managed portfolios where they want to actively manage risk, therefore getting access to secondary liquidity to be able to offload these assets as part of that risk management becomes very important. But do you need a multilateral exchange? And I think the consideration there really starts to come into, it's not the should or would, it's the can. Because ultimately, when we look at the principles of financial markets infrastructure, when you're making an asset available in a public offering, there are considerations around market fairness, price discovery, information symmetry that need to be borne out. This introduces market abuse regulations and disclosure requirements on these instruments, which largely just isn't sort of principally aligned to the principles of private assets, right? You want to be able to manage your valuation, you want to be able to control your price, you want to be able to drive visibility of your sort of activities around transactions in some form. And I think ultimately, the more you bring assets into public markets worlds and sort of multilateral infrastructure, where you are effectively providing that price discovery, it starts to really erode the sort of sell-side premiums on these assets. And so you will start to see friction for incumbents who actually want to engage on this. I know we're slightly over, but I will make one point. We are seeing some interesting evolutions, though, around provisioning access to new assets for or existing assets into sort of new markets. I think some of the work that BlackRock and others have done in the money market fund space has been really, really interesting, where you're taking existing assets that are relatively stable, providing them as a replacement for traders and investors in the crypto space as a replacement for their stablecoins, as a safe harbor instrument to be able to hedge their trading strategies whilst at the same time getting access to the yields on those assets. And ultimately, you're dealing with the issuer risk not against a private entity like Tether, who is relatively stable, but not all of them are. But your sort of issuer risk is against BlackRock, which we can talk about their stability, right? So,
Got it. I mean, any 30-second final words from any of you, if you have any?
The future is unlocked on-chain capital markets.
All right, so we had Dotun, Elliot, Raj, and Lloyd from respective industries and expert areas. Please give a round of applause to all these wonderful speakers that have created a great discussion. And also make sure to reach out to them if you have any questions. We did want to take questions on stage, but the time is already over with extensive discussions. So do reach out to them, say hi, and ask questions if necessary. Thank you all, speakers.